Did you know 7 out of 10 Americans will need some form of long-term care in their lifetime? And if you saw our last video, we explored how to include long-term care planning in your retirement planning. Hi, I'm Bud Milligan, certified financial planner and wealth manager with Milligan Wealth Management. And today, we're digging into the financial reality of long-term care. What will it actually cost? And how can you prepare to pay for it? If you believe Medicare will cover your stay in a nursing home or that Social Security checks will be enough, you don't want to miss what comes next. Let's talk hard numbers, the kind most families only discover when care is suddenly needed. Home care will be the first thing we talk about. Home health aide now costs a national median of $34 per hour. For those needing full-time care, imagine 44 hours per week, it's about $5,900 a month or $78,000 per year. Homemaker services, which cover chores, meal prep, and housekeeping, average just over $75,500 annually, having spiked 10% in the last year. And then there's assisted living. Assisted living facilities offer personal care, meals, and social activities, and the costs have jumped to a national median of $5,900 a month, or an eye-opening $70,800 each year. Factors like apartment size or amenities, from basic studios to luxury suites, can drive your bill much higher. Costs in states like Alaska and D.C. can easily top $80,000 to $90,000 a year. In states like Missouri or Mississippi, you may see $36,000 to $42,000 a year. Now let's talk nursing home. For the highest level of care, think 24/7 attention in skilled nursing facilities. Expect a semi-private room to run around $111,325 a year. If you want a private room, the national median is now $127 a year, or $128, or roughly $10,600 a month. Now in Texas, you may pay just $5,600 a month for a semi-private room. In Alaska, it'd be over $31,000 per month. So most certainly your geography has a massive impact. Urban and coastal areas with greater demand and higher labor costs command steeper prices. States like Texas, Missouri, and Oklahoma are consistently the most affordable, while Alaska, Massachusetts, and New York break the bank. So how do you create a realistic projection for your own future care costs? Well, here are 3 key factors to consider. The first is duration of care. Research tells us that women average about 3.6 years of care and men about 2.2 years. But a quarter will need care less than a year. About 1 in 10 may require extended support longer than 5 years. Duration hinges on health, family longevity, and lifestyle. The second to consider is inflation's bite. Long-term care costs outpace general inflation. Recent industry models project average annual increases of 4 to 5%. Number 3 is geographic variation, and we just mentioned some examples, but where you live or plan to retire really matters. Costs in cities like San Francisco or New York can double those in Midwest towns. Now let's talk about funding strategies and how to prepare for those costs. One way to pay for those costs is self-funding. This means using your own savings, investments, home equity, or even retirement withdrawals. Recent research suggests the first account to tap, once medical deductions are available, may actually be your traditional IRA or 401k, as high care expenses may offset your taxes. Taxably spending those funds during high expense years may be able to minimize your lifetime tax bill. But self-funding requires tremendous discipline and liquidity. A 3-year stay in a $10,000 a month nursing home could drain nearly $400,000, and that's not counting inflation or extra costs. Few Americans have liquid assets for more than just a brief crisis. Then there's long-term care insurance, or traditional long-term care insurance. Buying a dedicated long-term care insurance policy can give you some security. You pay an annual premium, and if you need qualifying care, you get benefits to cover expenses. In 2025, new annual premiums for a healthy 60-year-old ranged from about $90 to $1,700 for men and $1,500 to $2,700 for women to provide $165,000 in benefits. But beware, premiums can and do rise, especially for older legacy policies. Some of the challenges are that medical underwriting is strict with these policies. Health conditions can easily disqualify you. Premiums also rise over time, and if you never claim benefits or use it or lose it. And there are fewer insurers in the market, and policies can be hard to navigate. There are also hybrid life insurance policies or hybrid life insurance long-term care policies, and these blend permanent life insurance with built-in long-term care benefits. You pay a lump sum or a series of payments, and if you need care, the policy pays out tax-free benefits for qualified services. If you never need care, your heirs receive a life insurance death benefit. A $100,000 premium could provide $400,000 to $600,000 in long-term care benefits, potentially more leverage than self-funding. The strengths of this policy are that premiums never increase. If you never need a claim, then heirs get a death benefit. And also, cash benefits often do not require receipts or insurer's approval of caregivers. And some joint policies can cover both spouses. There are also annuities with long-term care riders, and these are gaining traction as a care funding solution. You deposit a lump sum with an insurer who includes a provision to increase payouts if you require long-term care. Unlike regular long-term care policies, annuities may have more accessible underwriting, sometimes available even to applicants with pre-existing conditions. Some annuities can double or triple your payout for years while you need qualifying care and then revert to baseline. There are also public programs. First, Medicaid. For those who qualify based on low income and assets, Medicaid is the nation's largest single payer of long-term care, which usually means nursing home care, but increasingly can fund home and community services. However, you typically have to spend down assets to qualify, and for most states, you have to spend everything down to about $2,000, and you may have little choice over the setting, the provider, or the amenities. Now, Medicare only covers short-term skilled nursing up to 100 days, typically after a hospital stay and for rehabilitation purposes, not sustained long-term or custodial care. Plus, after 100 days, all the costs are on you. Veterans also have certain benefits. If you served in the military, the VA's aide and attendance benefit can provide extra funds for in-home, assisted, or nursing home care, with eligibility based on service, medical need, and financial status. There are also state mandates, like Washington's WA Care. Some states are beginning to experiment with mandatory public long-term care benefits, a payroll tax to fund basic coverage for all eligible residents. In Washington, residents receive modest benefits but still face substantial costs for extended care. More states are studying these approaches. Now, how do you determine the right approach for your family? Consider the following framework. The first step is to evaluate your net worth and cash flow. Do you have enough liquid assets to self-fund at least 2 to 3 years of care, even after accounting for market downturns? If not, how much of a gap do you face? Do you have dependents or a spouse who needs assets preserved? Number 2, check your health and eligibility early. Are you in good health now? If yes, you could qualify for traditional or hybrid insurance. Earlier is better. If your health is poor, explore annuities or plan for Medicaid spin down if needed. Number 3, explore preferences and family situation. If you're staying at home is a priority, hybrid or indemnity type policies may give you flexibility. Medicaid may limit your options. Are family members able or willing to help with care? And if not, prioritize more formal solutions. Number 4, consider the tax implications. Large medical expenses in a given year often allow you to deduct much more of those costs, especially if paying with traditional retirement account withdrawals. Some insurance premiums are tax deductible, especially for the self-employed or via certain policies. Number 5, decide if you want leverage or asset protection. Traditional or hybrid insurance may provide more protection per dollar than self-funding, but they require health qualification. Annuities or self-funding can work, but they may consume more of your legacy. The conclusion here is that whether you want to age in place or secure the best care for a loved one, your strategy should be as unique as you are. With so many options and the potential for a long-term care event to decimate your retirement savings, make sure you consult with a certified financial planner to align your long-term care plan with your retirement plan. Knowing the potential impact is really half the battle. If you would like more information about long-term care insurance or other options for your healthcare needs in retirement, you can go to my website at milliganwealth.com and schedule an appointment by clicking on the Let's Talk button. We can jump on a call or virtual meeting to review your options or meet in person at my office. I hope you found this two-part series on long-term care helpful. If you did, please hit like, subscribe, and share it with others. I'm Bud Milligan, your financial bud, and I'm here to help you navigate long-term care one confident step at a time.